Yo guys, Leggy here and welcome to a new video. Today I'm going to be talking about the £5 a day we've been putting into the S&P 500. So what is the S&P 500? It is basically the top 500 stocks in America. So when you log on to Trading212, the one I'm invested in is VUSA. So there are many different companies which offer S&P 500 ETFs. The one we're looking at and have been investing at is Vivusa, which is by Vanguard. Obviously a big reputable company, which is the main reason why we're investing in it. It's the most popular one on Trading212. I have been made aware recently that there is actually ones with lower expense ratios. So that's the first thing which you need to look out for when you invest in an ETF. So an expense ratio is the annual fee that an investment fund charges its shareholders for managing its money. So you want to make sure that you're getting the best bang for your buck in this regard. The next thing you want to look out for when picking an ETF is whether it's got whether it's accumulation or distribution. So there's two sides of a coin here, and this you can figure out what this is by basically looking at the brackets at the end of the name. So if it's bracket ACC, it's accumulation. If it's brackets DIST, it's distribution. And the key difference is basically the distribution one will pay you back the money in cash. So this will come back into your account when the dividend is paid, and then you'll have to reinvest it yourself manually. Whereas an accumulation is basically it will reinvest this money straight for you. This means that people actually prefer accumulating because it saves you money over a long time with fees like investing back in. But obviously it depends on your investment goals. If further down the line you prefer to get the cash back in your account rather than just holding it all within the stock, you might find distribution to be better for you. Obviously, people find that distribution funds that actually return the cash into you gives you more control of your money. So if, one time you get a payment and you decide that you want to invest in another ETF with that cash, then you can do that. So there's swings and roundabouts both ways. There's not a right way, there's not a wrong way. It's just there are your two options. So iShares, which is a denomination for basically anything that is held by BlackRock. So if BlackRock has a share, they call themselves iShares, whereas Vanguard just go by their normal name Vanguard. iShares actually have a hedged ETF, which practically basically hedges against the US dollar. So you guys probably have noticed that if you ever invest in anything, you'll see the currency, which basically shows how the money's acted. So obviously currency fluctuations happen, which means the strength of like the US dollar compared to your home market will change, and this will basically be reflected within some price actions. You can see this in Trading212. I'll stick a picture of one just here. So now you guys know what to look out for when you're looking for an ETF. We'll go into the S&P 500 specifically. So as I said, it's the top 500 stocks in the US market. So this obviously changes, it's monitored, things come out of the S&P 500 every so often. It does change, but since its inception, it has actually given a return of about 10% to the investor. Yeah, since 2010, this has been close to about 15%. So it's been, higher in recent times. So if you want to look for more information on the VUSA, you can go on this website, which I'm about to go on. I'll stick the link in the description. But if we have a look at the VUSA, basically you can have a look at its price earnings ratio, its price book ratio, return on equity, stuff like that. But if you don't mind about that, you're just looking at, more information about it, more simpler information about it, you can see that its market allocation is 100% US. And this is the whole point of the ETF. If you want to go into the all world, you might want to go into VHYL or VWRL. They're two ETFs which I've gone into on my channel before. But you can also see its weighted exposure. So you can see that, its highest sector is information technology. So it's very tech heavy. And this is actually shown. So if you guys haven't heard of the Magnificent Seven, I went on about it in my video yesterday a little bit. The Magnificent Seven is the, like, you know, the go-to 7 big stocks which people are going into. People have been investing so much into these that these have accounted for 30% of the market capitalization within the S&P 500, and basically this means that it accounts for 30% of the market cap. Although there is an issue with this, obviously, if tech has a bad year, it means that, you know, the S&P 500 can decrease and lose a lot of the gains it has gained in the last year. So obviously that's something you need to be really careful of. But obviously you got to also look on the flip side of that and look at how much AI has brought us forward, and AI has really been a strong narrative within the stock market for the last year. So you can also see that it's split by financials, healthcare, consumer discretionary, communication services, industrials, consumer staples, energy, materials, real estate, utilities. So it gives you exposure to different parts of the market without going and buying 500 stocks. That is the whole point of this. And as I said, you can see, you know, if I look at the holding details, you can see how much of an exposure the S&P 500 has on the Mag 7, because you've got Microsoft Corp, 7% of funds, Apple, 5%, Nvidia, 5%, Amazon, 3.73%, Facebook, 2.42%, Alphabet, 2.01%, and then you might not see Tesla on that first screenshot, but if I stick the second one up, you can see Tesla at 1.1%. Tesla's been really struggling this year. I'll stick its market down here, but it's not been the best. So now that is that out of the way, let's have a look at actually our Trading212 pie. So I'll stick it up here. We have £2,750 in currently. It's 7.09% up. I'm not gonna lie, I will put, you know, you can see that I was putting £5 in for absolutely ages. I'll stick a screenshot here, and you will see a couple £10, £15. So basically this happens. I want to put £5 in a day, whether it's a market day or not. Obviously the market is shut on Saturdays and Sundays and bank holidays. So when this is the case, I basically just let the autopilot take over, and it means it puts the £5 in on the Saturday, £5 in on the Sunday. It's not invested because the market's not open, and then it invests £15 on the Monday because that's a Saturday, Sunday, and also what it would have invested normally on that Monday anyway. So the whole point of investing £5 per day is for dollar cost averaging. So if the whole point of dollar cost averaging, I'll put a graph up here, is basically so you invest at the highs and lows of the stock market. And basically this means that if a market crashes, you can capitalize on those low prices, but it also means that if the market's quite high at a time, you can continue to buy when it dips and then capitalize on that low price to lower down your average, and then hopefully eventually it will meet in the middle and surpass your buying point. So there's a lot of, you know, there's a lot of benefits to it. There's actually studies on dollar cost averaging and lump sum investing. There is pros and cons to both, but obviously lump sum investing, you're taking more of a risk that is at a good price, whereas, you know, people quite like to dollar cost average because it just means that you can set and forget. But we are up 7.09%. As I said, I got a bit spooked by the market when, you know, the world stuff happened. Proper did spook me out. So I did have to lump sum to make up for the days I missed. And also I've been adding a little bit extra myself because, you know, like, why wouldn't I? Just got a bit excited. But for the most part, been doing 5% overall. We are 7.09%. Our last dividend, as you can see there, was 3.72, £3.72. So we're getting to a point where our dividends are actually starting to get sizable. I believe I've basically doubled our position from that last dividend. So I imagine next time we'll get about £6, which will definitely take us over £10 total gained. But yeah, I'll carry this on. I will do loads more updates, but this one will be more in detail one because obviously you want to like you want to know what you're invested in, and I just hope that I did fundamentals basically in this, so you guys basically know the benefits of investing in an S&P 500, why you should also look at alternatives if you want diversification from the United States. But yeah, I'll see you guys next time. Peace.